The Japanese yen just hit its weakest level in almost 40 years. You have to go back to 1986 to find it this cheap. And here's the part nobody expected. For the first time since the Asian financial crisis in 1998, the United States and Japan are talking about stepping into the currency market together to prop the yen back up. The last time these two actually did a joint intervention was 2011, right after the earthquake and tsunami. But back then, they were pushing the yen down, because a strong yen would have crushed an economy that was already on its knees. This time, it's the exact opposite. And Trump has said, in his words, he wants to help Japan out of goodwill and friendship.
We have a good relationship with Japan. Japan's been very good to us, with the exception, of course, of Pearl Harbor.
So today's question is simple. Why won't Japan's currency crisis end? The honest answer? There isn't one reason. This goes back decades. When Japan's bubble burst in the early 90s, the country rebuilt its economy around a certain set of choices, and a lot of economists will tell you those choices are exactly why the yen is where it is today. We'll also get into why America suddenly cares, what's actually in it for Washington, and the strangest detail of this whole story. The US is planning to support the yen by selling euros, not dollars. Let's get into it. Take a look at this chart. This is the Bank of Japan's policy rate from 2016 to 2026. In 2016, they set it at minus 0.1%, negative, and then nothing. 8 straight years, the rate didn't move. March 2024, they finally raise it by a quarter point. March 2025, up to 0.75. And in 2026, they take it to 1%, the highest Japanese interest rate in 31 years. And it's still far below almost every other developed economy. So why did Japan sit at rock bottom for so long? Stay with me on this, because this is the thread that leads straight to the collapse of the yen. There are 3 big reasons. The first one starts in the early 90s, when Japan's bubble popped. Through the 1980s, Japanese house prices and stock prices went vertical. The economy looked unstoppable. Everyone assumed prices only went one direction, so everyone piled into property and stocks. Then, between 1990 and 1991, the whole thing came apart. Stocks crashed, property collapsed, companies went under, factories closed, banks ate enormous losses, and a lot of people lost their jobs. That's the bubble burst. What came next was deflation. Not inflation, deflation. Prices going down year after year. Think about what that does to your brain as a shopper. A TV costs 100,000 yen this year. You're pretty sure it'll be cheaper next year. So what do? You wait. Now the shop has no customers, so it cuts the price. And the customer sees the price falling and thinks, great, I'll wait a bit longer. That's the deflation trap. Falling prices kill demand, and dead demand pushes prices down even further. Japan got stuck in that loop for years, and that's the single biggest reason the Bank of Japan has kept rates on the floor, right up to today. 1999, they go to 0. That's the zero interest rate policy. 2001, they start quantitative easing. 2016, they go negative for the first time ever. The logic behind all of it was the same. Make holding money in the bank pointless, and people will spend it or invest it instead. More spending, more demand, and finally, prices start rising again. The second reason is Japan's debt, and it's enormous. Japanese government debt sits somewhere around 230 to 260% of GDP, one of the highest in the world. Let me put real numbers on that. Say Japan's GDP is roughly $4 trillion. At 250%, the debt is about $10 trillion, and somebody has to pay interest on that. At an average rate of 0.5%, the interest bill is about $50 billion a year. Manageable. Now push rates to 2%. That same debt now costs about $200 billion a year, 4 times more. That's not a rounding error, that's a budget crisis. So low rates weren't just about reviving growth. They were the only thing keeping Japan's debt affordable. The third reason is about inflation and consumer spending. From 2022 through 2025, Japanese inflation ran at roughly 2% for a long stretch. The BOJ didn't want to slam the brakes on that because raising rates makes borrowing expensive. Expensive borrowing means households and companies pull back and spending dries up. So the thinking was, keep rates low, keep people spending, keep businesses investing, and don't choke off the recovery you waited 30 years for. So when you put all 3 together, the picture looks reasonable. Japan kept rates low to drag itself out of a crisis and get the economy breathing again. But that policy created a problem nobody could avoid. Right now, the gap between Japan and America is roughly 2.5 to 2.75%. And that gap gave birth to one of the biggest trades on the planet, the yen carry trade. Sounds complicated. It isn't. Here's the whole idea. Borrow money where it's cheap, invest it where it pays more, and pocket the difference. Let's walk through it. An investor borrows 100 million yen at 1%, so the loan costs 1 million yen a year. Easy. They take that 100 million yen and convert it to dollars. At 160 yen to the dollar, that's about $625,000. Then they put that money to work in America, US Treasuries, corporate bonds, maybe shares in Nvidia or Apple. Say it returns 4.5% a year. So, paying 1% to borrow, earning 4.5% to invest. That 3.5% spread is the profit, before costs and risk. That's the yen carry trade. How big is it? Genuinely, nobody knows. The Bank for International Settlements tracks about $261 billion of direct cross-border yen bank borrowing. Other estimates put off-balance sheet carry positions near $1 trillion. And if you count every speculative short yen position out there, some analysts throw out a number as high as $11.3 trillion, which means a tiny move in Japanese interest rates can shake markets on the other side of the world. Here's how it goes wrong. Investors borrow cheap yen and pour it into US tech stocks, corporate bonds, treasuries. Then Japan starts raising rates. Suddenly, the cheap side of the trade isn't cheap anymore, and the whole thing stops making sense. So they start unwinding. They sell their foreign assets to pay back the yen loans. US stocks get sold off, and the yen gets stronger as all that money converts back home. We already saw a preview of this in August 2024. In 3 weeks, the yen jumped about 12% against the dollar. Investors rushed to unwind, dumped US assets to repay yen loans, and global markets got very messy, very fast. Traders describe this setup like a forest in the dry season. Dead leaves, dry grass, dry trees everywhere. Nothing's on fire. But one spark, and the whole thing goes up. The carry trade is the tinder. All it needs is a bad enough shock. But the carry trade isn't the only thing dragging the yen down. There's another one, and it's quieter. Japan's overseas investments. For decades, Japanese companies and investors have been buying abroad. Factories, businesses, stocks, bonds. It's built Japan one of the largest net international investment positions in the world. By the end of 2025, Japan's net foreign assets were around $3.5 trillion, meaning Japanese investors owned $3.5 trillion more overseas than foreigners owned inside Japan. Now, normally that's good news for the currency. Japanese companies make profits abroad, bring the money home, convert it into yen, and that buying supports the yen. Except that's not what's happening. Instead of bringing profits home, a lot of Japanese companies just reinvest them where they already are, in foreign projects and foreign businesses. So the money never gets converted, demand for yen never shows up, and the currency keeps sliding. Add it all up, and here's where we are. Since 2012, the yen has lost close to half its value against the dollar. Put another way, if you're an American spending dollars in Japan today, your money goes roughly twice as far as it did in 2012. Great if you're a tourist. Not great if you're the Bank of Japan. And the BOJ has been fighting back. It's been going into the currency market and spending billions of dollars to defend the yen. This chart shows the attempts, one after another, trying to stop the slide. Here's how that actually works. The BOJ doesn't step into the market itself. It works through commercial banks, and those banks buy yen or sell US dollars on its behalf. And where do those dollars come from? Japan's foreign exchange reserves, which are held mostly as cash and US Treasury securities. Now look at this graph. These are US Treasury holdings by country. As of May 2026, Japan is the single largest foreign holder of US government debt, and now the second one. Japan's holdings from February 2026 to May 2026. In 3 months, they dropped by roughly $96 billion. Why? Because Japan has been selling treasuries to get dollars and using those dollars to defend the yen, and that is making Washington very uncomfortable. Which brings us to why Trump announced the US would work with Japan to stabilize the yen. But here's the detail that makes this interesting. The United States is not selling dollars to buy yen. It's expected to sell other reserve currencies, euros mainly, and use those to buy yen. That's a very deliberately engineered move. It props up the yen without touching the dollar. Because if America sold dollars directly, the dollar itself would weaken. And that's the last thing Washington wants right now. So will it work? Japan has huge reserves, and it can absolutely hold the line through this round. But intervention buys time. It doesn't fix anything. Sooner or later, Japan has to deal with the structural problems underneath all of this. That's my take. What's yours? Drop it in the comments. I read them. And if you got something out of this, subscribe to Global Policy Show and hit the bell so you don't miss the next one. See you in the next video.